You think this week was Nvidia versus Apple? It wasn't. Yes, the crown of most valuable company on earth changed hands twice before lunch Friday, a $6 billion photo finish on two giants worth almost $5 trillion apiece. But if that's the story you're telling yourself, you're going to miss the one that matters, a quiet decision 3 weeks ago that cracked the entire AI trade open and set the money moving in 5 different directions. Start with the scoreboard, then I'll prove it.
On the surface, this looks like pure chaos. Chip stocks got dumped for a third straight session. Netflix cratered after the bell. An insurance company was the single best thing on the board. And while everyone stared at the tech screens, oil quietly ran up almost 12% on the week. 5 names, 5 stories, and everyone is telling you something real about where the money is actually moving next. The damage first. The S&P 500 closed Friday down 1% at 7,458. The Nasdaq dropped 1.4%. The Dow shed more than 400 points. Across the full week, the Nasdaq lost nearly 3%, its worst stretch in a month. One corner shrugged it off, retail stocks gained over 2%, and one auto retailer jumped more than 9%. But that was the exception. This wasn't a crash, just the end of the calm. The epicenter was semiconductors. The main semiconductor fund just posted its third losing week out of 4, down almost 9%. Remember, this is the exact same group that rallied over 130% in the 12 months before June. Straight up. So the real question isn't why chips fell. Stocks that climb that fast eventually fall on their own weight. The question is what changed the story underneath them. That's where the board gets interesting.
Stock number 1 is Nvidia, and its week was almost poetic. Friday morning it fell as much as 4.6%, and its market value slipped under $4.8 trillion. For about half an hour, Apple was the biggest company in the world again, a crown Nvidia had worn since May of last year. By the close, Nvidia scraped back on top, worth just over $4.9 trillion, beating Apple by roughly $6 billion. On a company this size, $6 billion is a rounding error. That's how close it was. Stock number 2, Apple, the quiet winner of this whole week. Apple is up almost 23% this year, and it did that while spending far less on AI infrastructure than anyone else in the club. No $100 billion data center arms race. And for the first time, Wall Street is rewarding that restraint instead of punishing it. The biggest company in America, proving you don't have to win the spending war to win the market. That single shift in taste is the thread running through everything today. Here's the framework to use. For 2 years, the market ran on one rule: whoever spends the most on AI compute wins, and the company selling the shovels, Nvidia, wins the most. Simple. Every dip got bought on that logic. This week, that rule cracked. Money stopped asking who's spending the most and started asking a colder question: who is actually going to earn a return on all that spending? And that question changes the answer for everybody.
When the question flips from spending to returns, the whole leaderboard reshuffles. The pure shovel seller suddenly looks exposed. The company that stayed lean looks smart. That's not a mood swing, it's a change in how the market values an entire sector. Which is exactly why an insurance stock and a barrel of oil suddenly matter as much as the chips this week. Stay with me, because the third mover is where this gets genuinely strange. Because stock number 3 is Travelers, yes, the insurance company, and it was the single best performer on the S&P this week, up more than 8%. It reported $10.04 in earnings per share. Wall Street was looking for $5.41. Let that sink in. That's not a beat. That's an 88% blowout, and its 4th straight quarter crushing estimates. So how does a boring insurer nearly double the number? 2 reasons, and both matter. Catastrophe losses fell almost in half this quarter, simply fewer disasters to pay claims on. And the company released $578 million it had set aside for old claims that never came due, dropping it straight to the bottom line. So in a week when investors were terrified of AI valuations, they ran into the least glamorous, most predictable cash machine on the board. When people get scared, they don't chase dreams. They chase certainty. Now stock number 4, and this is the one that stung after the bell. Netflix reported Thursday evening, and the stock fell about 9%. On paper the quarter was fine, revenue of $12.5 billion, up 13% from a year ago, and earnings a hair above estimates. So why the drop? Because the tiny miss was on revenue, and the guidance for this coming quarter came in soft. And the market's reaction is the real tell here. Think about it. A 13% grower, beating on profit, got punished 9% for a revenue miss of about $30 million on a $12 billion quarter. That is a market with zero patience for anything less than perfect. When investors treat a good quarter like a bad one, they're not really reacting to Netflix. They're telling you how nervous they've gotten about everything that's priced for perfection. And nothing on earth was priced more perfectly than chips, which delivers us to stock number 5, and the real story of the week, Micron. At one point this month, Micron fell as much as 13% in a single session, wiping out around $38 billion in value. Intel, right next door, dropped 21% over 7 trading days. Memory chips, logic chips, the whole complex got hit hard. And here's the part most of the coverage skipped right over: demand didn't fall.
Chip demand is still there. What broke was the story about the future. A slowdown in high-bandwidth memory expansion, a cautious outlook from Taiwan's giant foundry, and a growing fear that all this AI spending won't pay off fast enough. It's not a demand problem. It's a faith problem. And faith is exactly what a 130% rally was built on. But the decision that actually lit this fuse came 3 weeks earlier, and almost nobody connected it to the fall.
The chip story didn't happen in a vacuum, there's pressure building underneath all of it. Layer in the Federal Reserve. For 3 years, this market ran on one promise: rate cuts are coming. This week, that promise quietly died. Futures now imply roughly 1.5 rate hikes over the next 12 months. Read that again: hikes, not cuts. The whole direction of money just reversed on Wall Street. Higher for longer rates are poison for exactly the stocks that ran the hardest, the expensive, growth at any price names. Which is precisely where the AI trade lives. When money gets more expensive, investors stop paying up for profits that arrive years from now. They want cash today. Which is why, this week, they bought an insurer printing real earnings and dumped chipmakers priced for a decade of flawless growth. Same fear. Two opposite directions. On top of the Fed, a second pressure: oil. Crude jumped over 4% on Friday alone, and Brent pushed toward $85 a barrel, up almost 12% for the week. The trigger was rising military tension between the United States and Iran, plus fresh fear over 2 shipping choke points, the Strait of Hormuz and the Red Sea. Energy and utilities were the only major sectors smiling this week.
Now stack it all up. Chips falling, rate cuts vanishing, oil spiking, and even a great earnings report getting sold hard. That is a market yanking money out of the future and shoving it into the present, into insurers, into energy, into anything that pays you now. Every dollar that left a chipmaker this week had to land somewhere, and it went into things you can touch. This is the climax of the week. And it all traces back to one move, made on the 1st of July, that quietly rewrote the math under the entire chip trade. Here it comes. But first, next week, because it's loaded. Wednesday is the big one.
Tesla reports after the close, and here's the setup. We already know Tesla delivered 480,000 vehicles last quarter, its best second quarter ever, crushing the estimate of around 406,000. So deliveries are already a win. The entire game Wednesday is margins. Can Tesla actually make money on those cars, plus whatever Musk says about the Cybercab and the semi-truck? The stock has run into this print, so the bar is high. That same evening, Alphabet reports, and Wall Street wants revenue north of $100 billion, up nearly 24% from a year ago. Then Thursday, Intel, the wounded chip name, expected to show around $14 billion in revenue and a razor-thin profit, just pennies a share, while it tries to prove its factory turnaround is real. Tesla, Alphabet, Intel, back to back. Between them, they'll tell us whether this AI spending fear is a passing wobble or a genuine turn.
And the backdrop is better than the scary headlines suggest. Of the first 40 S&P 500 companies to report, more than 87% beat estimates. The banks crushed it. Earnings are strong. The problem was never the businesses, it was the price tags stapled to them. So the real test next week isn't whether these giants beat. They usually do. It's whether beating is even enough anymore, in a market that just punished Netflix 9% for a $30 million miss. So here's the decision I promised you. On July 1st, Meta announced it would start selling its own spare AI computing power to other companies. In one stroke, the single biggest buyer of chips signaled it might soon become a supplier of compute, quietly rewriting the supply and demand math the entire chip rally was built on. That's the fuse. That's why the market suddenly rewards Apple's restraint and dumps the shovel sellers. And it's why the money running out of chips had to find a new home, rotating into a boring insurer printing real cash and a barrel of oil, the two corners of this board that pay you now. 5 names, 5 directions, 1 fuse. The spending era isn't over. But this week, Wall Street stopped paying for the spending and started pricing the return. And that changes everything about where it heads next. Alright, that wraps it up. Like, save, subscribe, and we'll dig deeper next time.